I'm Adam Grimes, and welcome to Module 5, Unit 5 of the Art and Science of Trading. This is about trading system design, and I have kind of jokingly subtitled this, The Pointy End of the Spear. There's a good point there, though. You know, we've done a lot of thinking, a lot of conceptual, intellectual work, but the disconnect comes that all that actually matters in trading is what we do. That's actually a very important point. You know, you can have everything right in your head, but all that matters in the end is what we do, because you are going to execute trades and they're going to work out or they're not going to work out. They're going to be profitable or not going to be profitable. And that's all based on when you actually buy and sell. So the intellectual framework is very, very important. That's why we spent so much time on it. The concepts, we're going to work soon on psychology. All of this, though, is really designed to support the execution. That's what matters, what we actually do. The problem is if you start there, as many people do, many people, when they teach trading or talk about trading, they're simply like, see this pattern and buy here. It's not so easy to do. All of these things get in the way, and we have to have everything supporting the execution. But now we're going to think a little bit more about the execution. And I want you to think about this in context of 4 trading questions. What, when, how, and then another when. What to trade, when to get into a trade, and let's also say when to get out of a trade, and how much to buy and sell. And it would be different answers to these questions, but any trading system has to answer those questions. So what do I mean by system? Well, in casual discussions, when we think of a system as a fixed rule set that tells us what we will do, what we will not do. In trading design, when people talk about a system, many times they mean something that's computerized or algorithmic or absolutely 100% rules-based. However, I would argue that even discretionary trading, good discretionary trading, it has a large systematic component. When you're a discretionary trader, you're not just looking at the market and saying, I feel inspired to do this. And even if that is what's ultimately driving you to act, there are still things that you will do and will not do. And there's still things that you're doing with some degree of consistency, and this is what is responsible for your results. So the trading system is simply that. It's simply a set of rules that may be more or less fixed, more or less flexible, and they describe what you will do and when you will do it. Without that system, you're really just guessing. And without a system, your results are not going to have any degree of consistency, and you're probably going to be at the mercy of your emotions. Why is that a bad thing? Well, we haven't talked about the rules in a little bit, but markets are highly competitive. Market prices are driven by a combination of emotion and rational analysis, and that will the market has evolved to encourage people to do the wrong thing at the wrong time. If you don't have a system, you're going to be at the mercy of those emotions, and you're going to find yourself, try it. If you don't believe me, and many beginning traders would not understand why this is so difficult, experienced traders, even with a little bit of experience, you're already nodding. You know what I'm saying. You will find yourself doing the wrong thing with remarkable consistency. However, a system is really about, and this last point is very important, system is really about much more than where you get into a trade. And that's kind of what people think about. If I told you I have some magic system, I have the best system in the world, and what you're probably going to get from somebody telling you that is some secret methodology to tell you where to get into trades, where to buy or where to short. But really, all of these other things are extremely important. So let's talk about this. Let's back up a little bit and think about the questions. So you do need to think a little bit about choosing an asset class. And on the next slide, I'll show you some examples of asset classes, but many of you come to this work with a familiarity with one asset class. By asset class, I mean like stocks or currencies or, a big division like that. It's not that one is objectively better than another. Sometimes people will say, tell me what is the best thing for me to trade. Just tell me what the best thing is and I'll do it. One is not better, so you really can't answer that question. But it definitely is a case. You need to understand the differences because one might fit your trading style, might fit your personality, might fit your financial situation better than another. I would encourage you to be careful. We've talked a little bit about cognitive biases, and there is a tendency for people to think they have some special expertise in one asset class. Maybe that's true. It probably is true in some cases, but you'll see that in your bottom line. I've seen a lot of struggling traders who are very sure they have some special skill that's just not borne out by their results. So just be careful of that. When we think about what asset class to trade, well, what matters? So we need sufficient liquidity. You need to be able to get into a trade. Another way to think about liquidity, we've talked about the bid and ask spread a little bit, and you want that spread to be reasonable. If you had, for instance, let's just say, I don't know what it is, let's say we have a $5 asset, and let's say that the bid was $4.99 and the offer is $5. This would be a very tight market. This, assuming we're trading in dollars. This would be let's say it's 485 to 510 or something like that. This is a wider market. You'll see this kind of thing in a lot of options. Currencies sometimes some currencies will get relatively illiquid and the spread will get bigger. And you can manage that. You probably can't trade it as actively as you could trade this situation, but you could still trade it. This, however, might be a problem. If you had something like this, where it was 0.75 at 650, where you have that gigantic spread, it's going to be very difficult to, theoretically, as soon as you buy or sell, you're already down the cost of the spread. That's already a theoretical cost that's baked in, and then if you have to get out quickly, that theoretical cost will become a real cost. So this is what you would see very wide spreads in an illiquid asset. You also might want to think about granularity. And what I mean by this is simply the ability to trade small enough. And this is something, if we're trading shares, you can trade 1 or 2 shares of stock. If you're trading currencies, you can trade very, very, very small size in currencies. So that's something to think about. And you also want to give some thought to what time frame you trade. I could make a good argument that trading currencies on a 5-minute chart, it's a different asset class than trading currencies on a daily chart, or at least it's different enough that it's probably more different than it is the same. So these are things you need to consider. What are common assets? Well, we're not going to spend a lot of time on this, but just so you're aware, stocks, both indexes, stock indexes, which are averages of stocks, individual stocks, indexes can cover broad market, can cover regions, can cover the world, can cover styles, can cover sectors. A lot of different ways you can do this. Currencies, there are a handful of very liquid major currencies, and then there are many, many, many minor and what we would call exotic currencies. Just be aware the liquidity is very different. That in the major currencies, they're going to be pretty liquid most times of the day. Even then, you'll be surprised sometimes. There'll be times when major currencies, the spreads will widen, and some of the exotic currencies can be shockingly illiquid. So check that out before you trade those. Commodities, one of the problems with commodities, which are typically traded as futures, not always, but that's the vehicle within which we usually trade commodities. One of the problems with commodities is that the contract size tends to be large, and this means it's difficult to trade with very low risk. It's difficult for small accounts. That's a barrier. There are different ways to overcome that, but for somebody just beginning to trade with a little bit of money, trading commodity futures is probably a difficult way to go. Futures. So futures is basically a wrapper I know we won't get into this in too much detail, but if somebody says they're trading futures, you don't really know what they're trading, because a futures contract is essentially a contract for something to be delivered in the future. And what is that something? Well, that something could be stocks. It could be a stock index. It could be an individual stock. It could be currencies. It could be commodities. It could be volatility. It could be a lot of things. So when you're thinking about futures, you need to understand what is the underlying, meaning what asset is it based on, and you understand how the underlying moves and how the futures contract in most cases will track pretty closely. There are some complicating issues. Volatility, I would argue, is not an asset class. There are some good reasons to trade some volatility products, but you really, I can't say really enough times here, you really want to make sure you understand how they trade. For instance, people buying levered ETFs on the VIX as a hedge for their portfolios, that's a little bit silly. And if you're familiar with those products, you know why that is, but you really need to understand that. And then options, and you can have options on most, or actually probably all of the things above, and a lot of different things you can trade. But this is, and like I said, most of you probably come here with a familiarity and a comfort with one or two of these. If you trade for a long time, you may very well stay within that silo, but traders typically will start to explore other asset classes, and there are good reasons for doing so. However, bottom line is, before you start trading, you got to know what you're going to trade. When do you get into trade? Well, as I said before, this is what we think about casually when we talk about how to trade as beginning traders. This is everything we think about. It's just how we get into a trade. And I would argue, and certainly will continue to argue, that other things matter at least as much. You know, one of the problems with trading is that people say, what's the most important thing? What is the most important thing? The problem is everything is important. One of the ways I've thought about it is, okay, you have an airplane. What's the most important thing? Is it the engine? Is it the landing gear? Is it the wings? Is it the, so you can think about, or submarine, you can think about, if one of these pieces is missing, it's not going to work. And that's definitely the way it is with trading. If any of these pieces, including you're one of the pieces of your eventual success, if one of those pieces is not working, it's not going to work. It's the bottom line. Now, also do be aware, and we've spent a lot of time on this, I'm not going to hammer this anymore, but most of the things that people think work may not actually work. At least give it a question mark. Do not accept because people talk about such and such in trading forums, because people write books, because people sell little ebooks on things. Don't assume that those things actually work. Don't assume that anybody who you think is an expert actually is an expert. You need to do the hard work, and that's what you're learning to do here. You need to make sure that you have an edge and that you understand that edge. Well, what are some of the ways that people find the edge? This again is not exhaustive. Now, we spent a lot of time talking about what I would consider to be technical. And this is based on patterns in prices, could be patterns in returns. And look, I'm a technical trader. Our focus here is on technical trading. But when I say this is probably less effective than most authors would have you believe. That's because many authors would have you believe that there's some secret key to the universe. There's not. There's some small statistical edge. Go back to the rules, right? Fundamental analysis. So what we're looking for when we talk about fundamental analysis is understanding this slippery concept of value. And once we understand value, then we have this slippery concept of how price is attached to value. Because it's not always as simple as price is here, value is here, so the price is going to go here. Actually, if we went forward in time, you'd find value probably changes, and this delta, this difference between price and value encodes what? Emotion, rational analysis, expectations of expectations, and a lot of things. This basic idea, though, is that over enough time, price should converge more or less to value, and there certainly is great validity in this approach. Nobody can argue that fundamental analysis is worthless. We do need to think about what time frames different information might be important on. For instance, if you're trading on long-term fundamentals, It's probably not very effective for day trading. It's probably not effective for short-term trading. Macro analysis, I would say this is almost there's a lot of discussion and talk about macro analysis. I would say this is essentially a variation of fundamental analysis. And what we're really looking at doing here is to try to understand value. And many times, when we talk about fundamental analysis, a lot of times we're looking at value of an individual stock. It doesn't have to be, but an individual stock, or maybe understanding supply and demand to try to understand what the price of wheat, one of the words we would use in fundamental analysis is should be. It's one of the ways to think about it. Macro generally works with big themes. So you're trying to understand the value of stocks as a whole and what they should be, or a currency, or a commodity perhaps. And you do this through understanding economic, political conditions with some element of fundamental and perhaps even technical analysis baked in. Arbitrage deserves a little bit of discussion. So I told you there is no free lunch. Well, arbitrage is free lunch. So an arbitrage opportunity is where you just find risk-free money laying around and you can pick it up. You probably know have you heard the joke about the economist who sees a $100 bill laying on the sidewalk and he doesn't pick it up because it can't possibly be there. So we need to be careful about thinking about arbitrage like that. But the reality is, arbitrage is a real thing. It's capitalizing on mispricings. An example might be, go back to the days when electronic stock markets were less sophisticated. You might potentially find a case where a bid in one market or on one exchange was higher than an offer in another. So you could buy that with impunity, assuming you have some execution risk. But if you could do the buy and sell simultaneously, you pretty much could lock in a risk-free profit. That's an easy example to understand. Some arbitrage is quite complex, but really what we're looking at is some type of mispricing. You probably cannot do this at home. I say you can't do this at home on the slide. It probably should say probably, but you can't do it for very long because arbitrage opportunities go away. They're found. They're found, they're exploited, and the act of exploiting them makes them go away. So if there is a free lunch, it doesn't sit around for very long, and it's usually only accessible to people who have, let's say, privileged access or privileged execution skills. Do be aware, there's also this idea that, like selling option premium is risk-free. Sometime over the next decade, we can revisit that. People who are telling you, just sell fear, sell options are always overpriced. There will be a day of reckoning, and if you've based your trading on that, can you be profitable trading that way? Yes. Are you taking on tremendous risk that is hard to understand? Yes, and that is manageable, but it's not an arbitrage because by definition, arbitrage is risk-free, and selling option premium is certainly not risk-free. So how much to buy or sell? Well, a lot of different ways to do this. You can have no plan at all and just kind of hope for the best. You can do intuitive sizing. You might buy 10,000 shares of something, 5,000 shares of something. One of the possibilities is to do a portfolio allocation. If you have $100,000, you want to buy 5 stocks, you buy $20,000 of each. You could do the same with commodities or currencies. You could do a fixed unit or a fixed dollar. This would be where you always traded, let's say, 1,000 shares, which, by the way, is potentially kind of stupid, right? Because if you're trading 1,000 shares of a $5 stock and 1,000 shares of a $500 stock, you are taking on considerably different risk. Another possibility is fixed dollar risk. Now, here's where things get interesting, and if you are not familiar with these last three, pay attention because it may not be what you think. So fixed dollar risk. What the key word here is risk. What this means is that we are adjusting our position size so that each trade will be a consistent dollar loss if it loses. So in other words, just to kind of do it graphically, you have an entry price and then you have a stop price. And this is going to be very, very imprecise, inexact, but look at these two examples. So with one, you have a large distance between the stop and the entry, and both of these are long, obviously. And in the second, you have a smaller distance. So what you would do is you would trade larger in this case. You would trade more size so that both would be a consistent loss. And the math is relatively simple, but the idea here is that you're risking a fixed dollar or whatever your currency is. Fixed fractional risk. A fraction of what? A fraction of your account. So what this would mean is, let's say you're risking maybe 1% of your account equity per trade. The concept here is similar. You would size everything like this, but rather than having a fixed dollar amount, that dollar amount would be different with every trade because it would be based on your account size. And there are some issues with both of those to consider, but that's the idea behind it. And this question of position size, how much to buy or sell, is really very, very important. Another subset is volatility aware methods, and basically what this means is if a market is more volatile, bounces around a lot, and one is less volatile, you would want to have a smaller position in this market. And that could be smaller for a number of reasons, a number of ways you can do it. You can look to normalize the daily P&L contribution. Even this, in these two approaches, if you're setting your stop based on volatility rather than like one of the silly things people do, a fixed percent stop. You buy a stock and you risk 5% of the price movement. That's just silly. What's 5%? It doesn't make sense. But if you put your stop based on how volatile the market is, that's a much more intelligent stop placement technique. And you see some of these can be combined a little bit. Why do we care about this? Well, it matters. It actually matters quite a lot. If you have a good system and you trade too large, you will blow yourself up. Even with a fantastic system. We'll see examples of that in another module. If you trade too small, you're wasting your time. Imagine that you have, let's just put numbers on it. Let's say you have $1 million in trading capital and you make a few trades a week and you are a very consistent winning trader, but you size your trades so you only make $1. It's trivial, right? You just don't care. On the other hand, if you're risking many hundreds of thousands of dollars with $1 million, you're going to have a few losing trades in a row and all of a sudden you're down 30, 40, 50% of your capital. That's a difficult thing. So the right answer is somewhere in the middle, and it matters. You do want to be careful. There are these plans that will give you optimized answers. The Kelly criterion is one that people talk about. You have to be careful of these because they rely on assumptions. We've talked about this. They rely on models and assumptions, and the question is, how well do those assumptions hold up? Depending on the answer to that question, these can be workable, or they can be very, very bad. And one thing, there certainly are wrong answers. We'll come back to this, but this is just sort of to get you thinking along these lines. We also, we touched on this before, that a very common approach is to allocate. If you buy 5 stocks, you put 20% of your portfolio in each, and this is the amount invested. Do be aware that if you size for the risk of each position, that the amounts invested will look very strange. You could very well have a situation where you buy, I keep saying stocks, and you can adjust it for anything. You buy 4 stocks, and you're risking an equal capital amount, let me say this the right way. You're risking an equal dollar amount on each one. So if each trade loses, you will lose $10,000. But your portfolio allocation is not going to be 25%, 25%, 25%, 25% each stock. You might very well have one stock that has 10%, one stock that has 70%, and those have the same risk. The same risk, at least in terms of intended loss. Why? Because those are sized for volatility. So again, without digging into this too much, here's just some practical hints. We'll look at this a little bit more. You can make a very good argument that fixed fractional risk is the right answer. Capital allocated is almost certainly meaningless if you're an active trader and are just dividing a percent of your account per trade. It's probably not the way to do it, with some exceptions. And what are the exceptions? Well, I think the exceptions come from systems where you cannot define your risk on each trade. Those are, by the way, those are legitimate systems, and they'll tend to be mean reversion systems, intraday or daily. And with those, since you don't know what your risk is, then this calculation is impossible. So with those types of systems, then capital allocation may be the right answer. And also, by the way, it is risk management. If you are trading mean reversion and you allocate X percent of your capital to a trade and it goes very, very bad, the trade goes very, very badly, then you have some idea what the worst thing that can happen to you is. If you are, however, sizing with this fixed fractional risk, be aware that 4% is extremely aggressive. Risking less than 1% may be too small. That's worth a question mark. Again, it depends on a lot of things, not the least of which is your risk tolerance. And your risk tolerance is not something you can't be a cowboy. You can't say, "Oh, I'm going to have guts. I'm going to trade with big aggressive risk." That's not really the right mindset, because the correct risk tolerance is both your capital, how important the capital is as a percentage of your net worth, your characteristics of your trading system. A lot plays into it. But one thing that I would think about is, how will you handle multiple losses in a row? That's a very good way to think. Even if you're a high probability trader, you absolutely are going to have strings of 3 losses, 5 losses. You may have 7 or 8 losses in a row. It certainly is possible. And what if let's just take 5 here and say you're risking 10%. So you now have a 50% drawdown. It may have, if you're using fixed fractional, it's not going to be quite 50% because you're risking less each time, but it approaches that, let's say. And how are you going to handle that? Well, that's borderline catastrophic. Even at 5%, you're looking at a 25% drawdown, which is not easy to recover from. But at a 1%, you're looking at you're looking at a 5% drawdown, which is certainly manageable. Now, these numbers are not exact, but it's a reasonable ballpark. And this is one reason why you don't want to trade these crazy risk numbers unless you're just going to Vegas and you're treating your trading account as a lottery ticket, which is kind of a silly way to do it for most traders. When do you get out? Well, one of the key questions is, where am I getting out if I'm wrong? If you're a directional trader, every trade must have a predetermined risk point. If you're a systematic trader, then this may very well not be true. I would say that a fixed percentage risk is, and I don't use this word lightly, it's stupid. This is the advice that you'll find even in some good trading books, and a lot of people will tell you this, that get into a stock and risk 5%. I remember telling somebody they needed a stop that basically risked about 8%. They said, "Oh no, I could never lose that. I'd get fired." Well, you take care of that with your position sizing, right? Fixed percentage risk is stupid because it is meaningless. In the S&P 500, the average true average true range is a percent of the stock's price, ranged from 0.2% to almost 10%. So those are that's the average swing of a daily swing of a stock. And some of you might be quite surprised by this number. So if you're risking 5% in one of those very volatile stocks, then it's kind of silly. On the other hand, 5% risking in a stock like this is also equally silly. So if you do come from the mindset of using a fixed percentage risk, I don't use that word lightly, so I don't think it's a very smart thing to do. You also need to consider, so here's where we're getting at, if you're wrong, what if you're right? You do need to consider the impact of taking partial profits versus partial losses. And we're going to do a whole unit on these trade management decisions. I just want you to start thinking, will you use a time stop? What if you get into the trade and it doesn't go anywhere? Will you get out after a period of time? Are you all in, or are you scaling in? One is not better than the other, but depends on your trading style and your system, and also your personality. Same thing with getting out. you get all out, or will you scale out? Partial profits, partial losses. If you scale out, will you do that at a loss, or will you only scale out at a profit? These are the kinds of questions that you have to answer. You have to have clear answers to these questions before you start trading. And this is what a trading system is. A trading system will give you these answers. And if you don't have a system, you don't have any business risking money in the market, because you are going to lose. You may make some money, you may get lucky, but I would be almost certain that trade long enough and without a system, you're going to lose. And if you aren't losing, then you've developed a system. It's really the only way. So we can shortcut that. You know, you're going to be like, if I imagine you put 1,000 people in the market, you give them money to trade, and maybe a very small handful of them do evolve some kind of system, and they end up being successful. Rather than putting yourself through that process and hoping for the best, if we focus attention on creating a system, we can make your chances of success much, much higher. Also be aware that when we're talking about system, we're talking about a range from fully systematic to highly discretionary. This does not just mean a pure rules-based system. So how do you do it? Well, you come up with a trading idea, you test it, and we've talked about how to do that. You have a pretty good idea how to do some kinds of tests, and all of this testing is generally done on historical data. So this is all looking back. And you know, with any kind of test, we're finding patterns that have existed in the market in the past. It's unavoidable. You can't test the future. I look like I misspelled historical, as I was looking at the screen. But what we are hoping is if we do our testing correctly, we found a pattern in the past that will also exist in the future. And one of the ways to test that is with an out-of-sample test. Now, this is quite difficult. People will talk about out-of-sample, but there are reasons that many people who say they're doing out-of-sample are not doing out-of-sample. Because once you touch the out-of-sample data, it is no longer out-of-sample. And I would even argue with most of these markets, if we have lived it, there is no true out-of-sample data. So this one is quite difficult to do, almost impossible. We rely a lot on the forward test, which is you come up with your trading idea, you test it, you have some idea it works, and then you either trade it very, very small, I say on vanishingly small size, or you paper trade it. There's value in paper trading. This is just seeing, you hope when you have done your test that you have done the work so that future data does not contaminate, but it might. If you are forward testing, trading in real time, then you have insulated yourself from that future data. Of course, the emotional impact is very different, and then you trade small and increase size. This is kind of the plan, the big picture plan that most people follow. Maybe you could do it a different way, but it's hard for me to imagine getting through this workflow. You may skip a step, you may do a step in different order, but we start with a trading idea, and as it falls through each of these filters, we eventually end up to the point where we start increasing size and it becomes meaningful. Essential elements of a trading system: setup conditions, trigger conditions. So setup condition gives you a potential for a trade. Trigger tells you to make a trade. You may not have both of these. The trigger condition may exist without a setup condition, but for many systems, having the two makes sense. Will you use a stop loss or not? Where are your other exits? Will you have secondary entries? And position sizing rules. This is, if you don't have these elements, you probably are missing something. And if you don't have one of these elements, then you got to have a good reason to explain why you don't have one of these elements. Another idea is to manage your system systematically. You know, even in purely systematic approaches, if the market goes crazy, a human decides when to turn the box off and on. All of this very systematic trading is not quite as purely systematic as an outsider might assume. There's still some element of human intervention. Well, it is possible to automate this. You can have what we might call a meta system, which would monitor the system to see how well it's performing or monitor characteristics of the market. And if the market gets too crazy, it might turn the system off. But even that can be automated. The problem with this is that if you start to do this work, you run into a problem that you are only acting in very extreme conditions. And to have any understanding, any reasonable confidence of how those extreme conditions will play out, you need to look at a lot of data because by definition, these are extreme conditions, and you literally in historical record may have only 2 or 3 situations like this. In some cases, 1, in some cases, none. And how reliable do you think that work is? On the other hand, can you trade a system without thinking about this? Because there definitely could be a situation where markets become so crazy that you're forced to make a decision, at which point the market will be very emotional. You will be very emotional. And guess what? You'll probably make a mistake. So you need to think about this in some way, somewhere down the road. Not initially perhaps, but you do need to think about managing the system systematically. So what is a system? It's just a rule set to be applied consistently to markets. Consistently can include discretionary. This is supported by historical data, but the only thing that matters is our actions, what we do in the future. A system can cover a wide range of styles, from purely systematic to highly discretionary, a lot of different approaches, a lot of different ways to trade, and all systems require a few essential parts, which we have looked at several ways in this presentation. So that wraps up our first thinking about trading system design. I will see you back for one more unit. Thank you very much.